Welcome. My guest is Peter S. Cohan. He is president of Peter S. Cohan and Associates. They're a management consultant and venture capital firm. Among the many things that he does, he writes prolifically about the markets. And today we're going to be talking about a couple of recent articles, really about what moves markets and why financial media completely misses the boat. Peter, welcome back.
Thanks very much, Scott.
Where are we starting off on the wrong foot?
Well, one of the things that's very important to understand is that if you read the daily reporting about the markets, it's consistently looking for some event to try to explain why the market went up or down that day. One of the things I find very striking is that the Greek bailout, for instance, took place at the end of March of 2010. But the S&P 500 kept going up for another month. It just kept going, straight up as it had been since March of 2009, for another month after this Greek bailout, after this crisis was very well known in the media. And it wasn't until sometime in the end of April that the market started to tank, at which point the financial media started to notice that this was going on and use that as an explanation for why the market was tanking. So this is one of the most common things that happens, is that financial reporters confuse coincidence with causation. That's the basic concept. Namely, two events happen at the same approximate time, and the media conflates that into meaning that one thing caused the other, which is a very, very different thing. And the fact that there's no real actual reporting on what moves the markets up and down, I find very annoying, and it actually got me going in terms of talking to people who are actually moving the markets, namely high-frequency traders who control 70% of the daily trading volume.
And it's true, much of what you say is true. In recent past, every time the market has gone down, it's always been because of Europe. You're saying that we need to look at the people who have the most impact on the market, who are doing the most trading.
Yes, and we need to understand the logic of their decisions. Why are they buying and selling securities? And in my efforts to understand that, I've been talking to people who get involved with high-frequency trading and know what they do. And the bottom line is that all this discussion about trying to forecast what the economy is doing, looking at politics, looking at individual companies and their performance and their prospects and how well they're doing in their markets is all irrelevant to the decisions of high-frequency traders, because high-frequency traders hold stock for 11 seconds. And the simple fact of the matter is that those people do not have the time to even figure out the name of the company that they own. They know the trading symbol, but they don't know the company. They don't know the name of the company. They don't know what it does. They don't know how it's doing financially. Their insight into the company has nothing to do with all the things that people talk about in the media.
It's been said, too, that computers do the majority of the trading. Obviously, there are people behind these computers. Are they changing the strategy each day?
I don't know what they're doing. They have algorithms, and as far as I can tell, there are two or three things that they seem to do that seem to account for a lot of the volume. One of the things that seems to be most common is this thing called flash trading, which is all having to do with computers which are located somewhere between 800 and 1,000 feet away from the computers that are actually doing the execution of trades on the New York Stock Exchange and the other big exchanges, is that you have these computers next to other computers, and what they do is they're able to intercept orders on the way to those markets to be implemented. And they get those orders about 100 to 300 milliseconds before they're actually executed. So they have a fraction of a second to analyze that order and look at what's going on, whether it's trying to buy a stock at a price that's higher than the current market or sell a stock that's lower than the current market. If they see a huge order coming in to sell shares at a price that is below the current market price, they can front run that order. They can essentially place an order designed to profit from that anticipated decline in the price. So they actually can do. That's one form of flash trading, high frequency trading. Then there's another form which is called latency arbitrage, which I love the names that these people make up. Latency arbitrage basically means that they are able to, again with their computers right next to the computer on the stock exchange, they're able to buy real-time prices from the exchanges for about $100,000 a year. They then have a computer that quickly calculates what the price is using some kind of a formula and gets the actual price of the stock before the retail investor does. So once again, they can front run the price. They can, if a stock is trading for $20 and 2 cents on the exchange, but they know that the real price is $20 and 4 cents, they can take advantage of that and they can make 2 cents on the trade. And the key thing here is that these market makers, these flash traders, high-frequency traders, are making only about 1 to 3 cents on each of the trades. But when you add it up over the huge volume of trades that they do with these computers, in 2008 it was estimated that they make about $20.8 billion in profits, which are risk-free because all they're doing is they're getting a fraction of a second ahead of other traders with no risk at all because they know what the price is going to be in that T plus whatever fraction of a second, and they're gonna profit from it.
My guest is Peter Cohan. He is an author and president of Peter S. Cohan and Associates, a management consultant and venture capital firm. Peter, as always, a great pleasure talking with you. Thank you.
Thank you.
This is Scott Drake. You're watching Annuity News Now.